We've got rising commodity costs, rising interest rates, and a strong dollar. Those three things together are extraordinary. So here is a combination of those three against the ISM, and it's already pricing in a recession. ISM below 47 is a recession. It's saying the 9-month forward ISM is going to be 37, and it's still going. So it kind of feels that we're going to go into a very sharp, urgent recession. All you're trying to do in the investment game is put probability in your favor. That's all we do. And it's trying to figure out, okay, how do I get to a trade idea? Most people just kind of bring them out of nowhere and think, well, I just want to do this trade. Maybe it's based on technical analysis. Maybe it's based on some fundamental piece of news. But I do it in a very different way. I take a very structured approach, which is, what is the long-term secular trend? I almost never trade against my secular trends. I'll either go with my secular trend or not at all. Then once I've got a secular trend, the single most important driver of all asset prices is the business cycle. And I use the ISM survey as the guide to the business cycle, which is basically just mirrors GDP, but on a monthly basis. So I use the business cycle to analyze where markets are going. So the year-on-year rate of change of almost all markets is actually the same as the ISM survey. It's kind of a really weird thing, but that's how it works. So the business cycle is the most important driver of asset prices. The secular trend then gives you what you want to do. So secular trends are often, in my world, debt, demographics, technology, things like that. You need to have an eye on those trends. Then you have an eye on the business cycle, and then you get down to, okay, what do I want to do and what trades are there? And then I tend to use technical analysis, sentiment analysis, flows, that kind of stuff to then get the odds further in my favor. So I try and build the whole thesis out. I also look at history. I look at a lot of history and say, when has things been similar? And I don't expect a complete repeat, but humans are humans. We're reacting the same way to roughly the same set of circumstances. And so I tend to look for those kind of setups. So if I can explain all of it, I tend to have a very high probability of being right. But those kind of big setups come infrequently. I'm not a frequent trader. I'm more of a big picture, macro, long-term position taker. Yeah, so the market is currently obsessed by inflation. It's obsessed by the central banks. It's obsessed by interest rates going super high. We saw Bill Ack coming out yesterday saying, interest rates need to go up to the moon. I step back from the narrative and start looking at, okay, what is the reality of that? And I think the reality is, and I'll show it in the presentation, that what we've actually done is utterly destroy demand already. We've had the largest rate of change of interest rates in history, the largest rate of change of commodities in history. We've had the largest rate of change of mortgage rates, all sorts of stuff, a very perky dollar as well, a strong dollar. That makes a big difference to this. Those things tend to be financial conditions tightening. We can see it in the equity market. We can see it in the housing market. You can see it in the crypto market. Conditions have tightened dramatically. The market's still looking at the previous CPI prints, and CPI is a lagging indicator. The forward-looking stuff of the business cycle is collapsing. And that's interesting to me because that fits with my secular framework, which is disinflationary, slower growth over time, with this aging population, demographics, all of this stuff all coming together. So that's why I'm really paying attention right now. I think the market's probably wrong. And I think that it's going to set up for a whole bunch of opportunities as the Fed pivot fast and the economy goes into recession much quicker than anybody expects.
Powell also talks about the importance of the business cycle in predicting future market movements. According to the macro guru, the business cycle is about to take a huge hit. He adds that there are strong indicators that the ISM Manufacturing Index or the Purchasing Managers Index, a key indicator of the state of the U.S. economy, is about to crash to a 50-year low. If this happens, Powell sees the economy plunging into a very sharp and urgent recession.
So we're in a slow growth world driven by demographics and debt. The central banks need to keep propping it all up, and that keeps going into the future, and that's baked in the cake. So that's the secular structural view. But now let's talk about demand and where we are in the business cycle. The business cycle is looking like it is about to roll over really, really hard. And I talked about the massive monetary tightening we've had. This is the biggest monetary tightening in all recorded history in the shortest period of time. We've got rising commodity costs, rising interest rates, and a strong dollar. Those three things together are extraordinary. So here is a combination of those three against the ISM, and it's already pricing in a recession. ISM below 47 is a recession. It's saying the 9-month forward ISM is going to be 37, and it's still going. So it kind of feels that we're going to go into a very sharp, urgent recession, and that's what the markets are picking up. That's what crypto's picking up. That's what equities have been picking up. Equities are currently pricing the ISM on a year-on-year basis at around 49. So they've got further to go to price in some of this, but the comparisons get easier because the market went up a lot this time last year going forwards. So I'm looking closer towards the low, and I'll come into that in a bit. So let's look at the rising commodity costs of the equation and why this is so bad. Food prices, the largest increase in food prices since 1990, and it goes back to the 1970s. So this means if your food bill goes up and your wages haven't been going up, therefore you have, well, if wages have been going up in inflation adjusted terms about 5% and food has gone up at 9%, you can afford less other goods because you keep consuming food. So food is one of these inelastic goods that destroys demand in the economy. And as I said, your wages have gone down in inflation adjusted terms because wages have been rising at about 5.5%, but everything else is rising faster. And that led people to take out more credit again. So credit's been increasing, and credit's been increasing about 6% a year right now, and that's offsetting the difference between commodity prices, cost of living prices, and incomes. The other thing people did was save a load of money over the pandemic because they didn't spend it as much, and they were given direct transfer payments. They've now pretty much eroded it and gone back to trend. Now, you really want to see the personal savings rate increasing, which it's been doing because of the retirees. But we're back to where they were, so all net gains have gone. They've spent all their money. They've started borrowing money. That tells you demand is about to be destroyed, and that any of the retail sales numbers that have been perkier are going to start dying off pretty fast. My view is that for once, the US consumer won't be saving the day. And it's kind of something that's believed to be a truism in markets is the consumer always saves everything in America. I think we've probably broken the consumer. So input costs are also rising. So that was the consumer level. But now let's look at all other commodities. Now, we saw the largest rise of commodities again for decades. The rate of change of commodities now is falling sharply, which is why I think inflation falls sharply. The year-on-year rate of change matters the most, not the absolute level of oil, for example. It's the year-on-year rate. That's turned down. We will see CPI turn down with a vengeance soon. But we're still paying for that spike that we had. And that spike was dramatic. That spike translated through to PPI inflation. So producer inflation, input costs, went up dramatically. Now, if you invert those, well, guess what? Higher prices lead to economic slowdowns. So because you've got this indebted old economy, the moment you raise prices, demand gets destroyed. And this is, again, pricing the ISM down at 30, which will be the worst ISM print since 1970.